How does a 40-year-old financial firm drop the average fees it charges its clients, pay out a significantly smaller percentage of its revenue in employee bonuses, and somehow still manage to double its earnings per share in a single year?
I mean, it sounds like a riddle, right? Or just a massive accounting error.
Yeah, exactly.
But when you actually peel back the layers of their, financial machinery, you realize it is just a masterclass in scale.
Okay, let's unpack this. Welcome to this Talk Ticker style deep dive. Today, we are pointing our microscope squarely at the Q2 2026 earnings call for Acadian Asset Management.
Right. The ticker is AAMI.
Exactly, AAMI. And our mission for you, the listener, is really simple. We are cutting through all that corporate jargon, the dense Wall Street speak to, isolate the most critical data-forward takeaways for your portfolio.
Because, reading an earnings transcript for a quantitative asset manager, it can feel like trying to read a dead language.
Oh, absolutely.
They talk about basis points, variable comp ratios, algorithmic alpha, as if everyone just instinctively knows how these mechanisms interact to produce cash flow.
Right.
So our goal is to translate that machinery into plain, actionable language that you can actually use.
So let's just start with the baseline data, because the headline numbers in this Q2 report are absolute blowouts. We are talking about top and bottom line figures that completely shattered expectations.
They really did.
Acadian's economic net income revenue, and we will definitely translate that term in a second, came in at $183 million for the quarter.
Wow.
Yeah, that is a 47% increase year over year.
And just to put that 47% into context, right? The asset management industry is generally considered a mature, slow growth sector.
Very slow.
Yeah, a legacy firm is usually thrilled to eke out 5 or 6% revenue growth, hitting nearly 50% growth. That implies a massive structural shift in how they are capturing market share.
And the bottom line is even more staggering. The E&I diluted earnings per share skyrocketed to $1.33. That is a massive 108% increase over the previous year.
But before we pop the champagne, we really have to address the elephant in the room regarding the accounting.
Right, because if you were to just glance at the raw U.S. GAAP numbers on their filing, generally accepted accounting principles.
The official numbers, basically.
Zach, the story looks vastly different. U.S. GAAP net income was reported at just $24.3 million, and the GAAP EPS was only 68 cents.
Yeah, that's a huge drop-off.
So we are looking at an official GAAP EPS of 68 cents versus this, adjusted economic net income EPS of $1.33.
Right.
Why is there a 65-cent gap between the two, and which number should you, the investor, actually care about?
So that discrepancy is probably one of the most common stumbling blocks for retail investors when they're analyzing financial stocks.
Oh, for sure.
GAAP accounting rules are incredibly strict by design, right, to prevent fraud. But they can heavily, heavily distort the actual cash-generating power of an asset management business.
Okay.
So economic net income, or ENI, is a non-GAAP measure that management teams use to strip out all that non-cash accounting noise.
Let's make that concrete for a second. When you say non-cash accounting noise, what specific line items are dragging that GAAP number all the way down to 68 cents?
Well, in Acadian's case, it heavily involves things like the amortization of intangibles, adjustments for profit interests, and this is the big one fund consolidation.
Fund consolidation. Okay, what does that actually mean?
Take seed capital, for example. Yeah. If Acadian launches a brand new investment fund, right, and they provide the initial seed money to get it off the ground.
They put their own corporate cash into it first?
Exactly. GAAP rules might actually force them to consolidate that entire new fund's balance sheet and any temporary unrealized market losses directly onto their own corporate income statement.
Okay, I think I need an analogy for that. Are you saying it's okay, let's say I own a property management company and I decide to buy a dilapidated house to fix up and rent out.
Okay, tracking.
My core business of managing other people's properties is generating tons of cash every single month. It's doing great.
Right.
But because I bought this one fixer-upper, the strict accounting rules force me to report the massive depreciation of its rotting roof on my main income statement.
Yes.
So on paper, my net income looks terrible. But in reality, my actual bank account from the core business is just overflowing.
It's a highly effective way to visualize it. You didn't actually write a physical check for the rotting roof that month, right?
Right.
It is a paper loss. So E&I strips out that paper loss. It removes the temporary distortions from that seed capital consolidation or non-cash equity compensation to show you the core operating health of the firm.
Got it.
It basically asks one very simple question. How much actual cash did the business of managing client assets generate this quarter?
And the answer to that question is a 108% jump to $1.33 per share.
Exactly.
Now let's look at the margins, because this ties directly into how they achieve that massive earnings explosion.
Yeah, the margins are wild.
On an E&I basis, their operating margin expanded by nearly 10 full percentage points. It landed at an incredible 40.3%.
Which is huge.
Concurrently, their operating expense ratio dropped 8 points down to 36.8%.
Right.
But I am looking at these numbers, and I have a really hard time believing this isn't mostly just a byproduct of a broader market rally.
Oh, so?
Well, I mean, global equities had a fantastic second quarter in 2026. When the stock market goes up, an asset manager's total assets go up automatically.
True.
Which means their fee revenue goes up without them doing literally any extra work. So isn't this 10-point margin expansion just a temporary sugar high from market beta?
That is a completely fair question. But what's fascinating here is that while market beta certainly provided a tailwind, no one is denying that, it absolutely does not account for a 10-point margin expansion on its own.
Okay, then what does?
What you are witnessing is a textbook, almost aggressive demonstration of operating leverage. And to understand how potent that is, you really have to look at Acadian's fundamental business model.
Right, because they are a systematic quantitative investment firm.
Exactly. Meaning they aren't employing floors and floors full of traditional stock analysts, manually reading corporate balance sheets and calling up CEOs on the phone.
Right, it's not the 1980s anymore for them.
No, not at all. They use highly complex computer models, massive alternative data sets, and algorithmic execution to manage all these portfolios.
Okay.
And the cost structure for that specific type of operation is heavily front-loaded. It's fixed. You have to pay top-tier data scientists, you have to build the literal server infrastructure, and you have to license the data feeds.
Which is incredibly expensive up front.
Extremely. But once that infrastructure is built,
the marginal cost drops.
Exactly. Once it is built, the marginal cost of taking on a new client is essentially zero.
Wow, okay.
Think about a traditional active Wall Street firm. If they want to manage another $10 billion, they probably need to hire 5 new portfolio managers, a whole team of junior analysts, maybe a new compliance officer.
So their expenses scale linearly right alongside their revenue?
Exactly. But for a systematic firm like Acadian, if a sovereign wealth fund hands them $10 billion tomorrow, the computer algorithm just crunches slightly larger numbers.
Right. The server doesn't ask for a raise.
The server doesn't ask for a raise. So the revenue grows, but the expense line stays completely flat. Every extra dollar of management fee drops straight through the income statement to the bottom line.
That is operating leverage in its purest form. And I guess that explains why the expense ratio plummeted by 8 percentage points.
Yep.
They grew their top line by 47%, but their fixed costs barely budged.
That's the beauty of the model.
Okay, so that makes the math crystal clear. But it kind of forces us to ask the next logical question. To trigger that level of operating leverage, you need massive amounts of capital actually flowing in the door.
You do.
And the numbers tell us AUM assets under management hit a record $232.7 billion, which is up 54% year over year.
Right.
But here is the metric that proves your point about this not just being a market beta rally. Net client cash flows were $4.3 billion for the second quarter alone.
And that figure, honestly, is the crown jewel of this entire earnings report.
Yeah.
Because net client cash flow represents brand new money walking in the door. It is completely independent of whether the stock market went up or down that quarter.
And it marks their 10th consecutive quarter of positive net flows.
10 quarters.
Which translates to a 9% annualized organic growth rate. Now, in the current landscape of the asset management industry, that level of consistent organic growth almost unheard of.
It really is rare.
I mean, we watch active managers bleed billions of dollars every single month as clients abandon them for cheap, passive index funds like Vanguard or BlackRock ETFs.
Right. The passive wave.
So how is Acadian defying that gravity? Why are institutions willingly handing them $4.3 billion in a single quarter?
It comes down to the only metric that institutional allocators truly care about at the end of the day.
Which is?
Alpha.
Ah.
Alpha being the excess return an investment generates relative to its benchmark index.
Okay, let's hit the specific data point from the call on that. Acadian reported a 4.3% revenue-weighted 5-year annualized return in excess of their benchmarks.
Which is incredible.
I want to pause on that for a second because for retail investors who are used to looking at tech stocks that swing 20% in a week, 4.3% might actually sound kind of small.
Right, it doesn't sound like a lot in a vacuum.
But in the institutional world, outperforming your benchmark by over 400 basis points annually for half a decade while managing over $200 billion.
It's monumental.
It really is.
It is literally the difference between keeping a major institutional client and losing them. And more importantly, that outperformance isn't just isolated to like one lucky flagship fund.
Right.
The transcript highlights that 96% of their strategies, weighted by revenue, outperformed their benchmarks across the 3-year, 5-year, and 10-year periods.
Wow. 96% over 10 years. That consistency over a full decade is what proves the computer models actually work across different market cycles, right?
Exactly.
Through bull markets, bear markets, inflationary periods.
And that is exactly what institutional consultants demand before they even think about recommending placing billions of dollars with a firm.
Makes sense.
But to understand the true story of this quarter, we have to look at where that new money is actually going, because the product mix under the hood is undergoing a radical shift.
Okay.
The growth isn't just coming from standard plain vanilla equity funds anymore. Management specifically cited massive demand for what they call enhanced and extension strategies.
Okay, this is where the jargon gets pretty thick. Let's break these down for the listener, starting with enhanced equity.
Sure.
If a traditional long-only fund is just a human portfolio manager buying 50 stocks they think will go up, what makes an enhanced systematic fund different?
So think of an enhanced equity strategy as a bridge. It's a bridge between purely passive index investing and aggressive active management.
Okay.
A passive index fund, like one tracking the S&P 500, just blindly buys all 500 companies in exact proportion to their size.
Right. You get the market return minus a tiny fee.
Exactly. It guarantees you will match the market, but you will never, ever beat it.
Yeah.
Now, an enhanced strategy starts with that exact same index, but it gives the algorithmic model a very tight leash.
Yep.
They call a low tracking error allowance to make slight calculated deviations.
Okay. So the computer might look at the S&P 500 and say, we will hold 490 of these companies exactly like the passive index does. But our data shows these 5 specific companies have terrible momentum and declining cash flows, so we will slightly underweight them.
Yep.
And these other 5 companies have incredible metrics, so we will slightly overweight them.
That is exactly the mechanism. It is trying to squeeze out just a little bit of excess return, maybe 1 or 2% alpha, without taking on the massive volatility risk of a highly concentrated active fund.
Got it.
And because it is a much closer substitute for a passive index fund, clients expect it to carry a much lower management fee.
Which brings us to the extension strategies, which frankly sound inherently more complex.
Oh, they are. Extension strategies are mandates that allow the algorithm to utilize a combination of long and short positions. The classic industry example is a 13-30 fund.
Okay, walk me through the exact mechanics of that. If an institutional client gives Acadian $100 million for a 13-30 mandate, what does the computer actually do?
All right, so the algorithm takes that initial $100 million and buys $100 million worth of stocks that its models rank highly.
Okay, so at that point, they are 100% invested in the market. They are completely long.
Correct. But the mandate allows them to extend their exposure. So the algorithm simultaneously identifies $30 million worth of stocks that it believes are fundamentally flawed or overvalued or just about to drop.
Okay.
It borrows those specific shares from a prime broker and short sells them into the open market.
Meaning they sell shares they don't actually own, hoping the price drops so they can buy them back cheaper later and pocket the difference?
Yes. And when they short sell that $30 million worth of stock, they generate $30 million in raw, immediate cash.
Right.
The algorithm then takes that newly generated cash and buys another $30 million of the highly ranked stocks.
All right, let me make sure the math checks out here.
Go for it.
The portfolio now holds $130 million in long position stocks. They actively want to go up.
Yes.
And they hold $30 million in short position stocks they actively want to go down.
Exactly. And if you subtract the 30 million short from the 130 million long, the net market exposure is still exactly $100 million.
Ah, okay.
So they haven't added massive leverage in terms of overall market beta, but they have extended their ability to generate alpha by actively profiting from the losers, not just the winners.
That is brilliant, but it obviously requires incredibly sophisticated risk management to ensure those short positions don't blow up in their faces.
Oh, absolutely. Short squeezes can be fatal if you aren't careful.
Right, which totally explains why a firm with 40 years of systematic data processing would excel at it. They have the models to manage that risk unemotionally.
Precisely.
But here's where we need to connect this product mix back to the financial statements, because CFO Scott Hines revealed a detail on the call that could easily terrify a retail investor if they don't fully understand the context.
The fee rate drop.
Yes. He noted that because they are selling so much of these enhanced strategies, the firm's blended fee rate actually dropped. It went from the upper 30s down to the lower 30s in basis points year over year.
Right.
And just to clarify, a basis point is 1/100th of a percent.
Exactly.
So if your average fee rate is dropping, isn't that a massive red flag for margin compression? Like, are they losing their pricing power?
In isolation, yes, you would usually worry about that. A declining fee rate usually indicates a price war, right?
Yeah.
But Hines was very careful to contextualize this. The fee rate compression was mathematically driven by a massive multi-billion-dollar installation they won late in the first quarter from one major client.
And we know from other industry data that this ties to St. James's Place, right? A massive wealth management powerhouse over in the UK.
Exactly. And when you win a mandate that large, we're talking billions of dollars at once, you offer volume discounts.
Like buying in bulk at Costco.
Exactly like that. The fee percentage drops, but the sheer velocity of the assets coming in completely overwhelms the rate reduction. And CEO Kelly Young emphasized that the demand for these enhanced strategies is shifting from just a non-US phenomenon to something that is very much global in nature across their whole pipeline.
So just to synthesize this for you listening, they are charging slightly less per dollar managed on these specific products, but because they are pulling in literally billions of dollars in volume, their total management fee revenue still surged 44% to $177 million.
They are making it up on staggering volume.
Right. And this structural shift in how they generate revenue created a really fascinating ripple effect on their compensation structure. I mean, this is arguably the most elegant part of the whole earnings report.
You're talking about the variable compensation ratio.
Yes. The transcript shows this ratio dropped to 37.5%, which is down significantly from 45.4% in the same quarter last year.
It's a huge drop.
Let's make sure everyone understands the gravity of this. Their revenues are up 47%, their earnings are up over 100%, yet the proportional slice of the pie they're paying out to their employees in profit sharing actually shrank.
Right.
How does management justify that to their staff without causing a total revolt? I mean, the firm is crushing it, but the bonus pool shrinks proportionally.
It is entirely mechanical, and it's based on the two distinct ways an asset manager earns revenue: management fees and performance fees.
Okay, management fees being the recurring, predictable subscription revenue they earn just for holding the assets, regardless of daily market performance.
Correct. It is stable. It's the baseline. Performance fees, on the other hand, are highly volatile. They are the bonus the firm earns only when they actually beat their specific benchmarks by a certain margin.
Like hitting a high watermark.
Exactly. It requires them to clear that high watermark. Now, the variable compensation pool, which is the bonus money paid out to the portfolio managers, the data scientists, the executives, that pool is heavily, heavily weighted toward those performance fees.
That makes intuitive sense. You eat what you kill. If the algorithm crushes the benchmark and generates massive performance fees, the engineers who built the algorithm get huge bonuses.
That's the incentive structure.
Yeah.
But look at what happened this quarter, because they brought in that massive $4.3 billion in net flows, mostly into those enhanced strategies we just talked about.
Right, which generate huge, predictable management fees.
Exactly. The recurring revenue pool grew exponentially faster than the lumpy performance fee pool.
Ah, I see the math now. The baseline subscription revenue became so massive that it just dwarfed the performance fee component of the overall revenue pie.
Yep.
And because the employee bonus formula is less aggressive on base management fees, the overall blended compensation ratio just naturally floated downward.
Hines confirmed exactly this on the call. He noted that the recurring management fee profit pool grew to such an extent that it mechanically drove the variable compensation ratio downward.
Wow.
And this is not a one-off anomaly. Management guided that they expect this efficiency to remain stable. They are projecting a full-year variable comp ratio between 38% and 42%.
So for you, the retail shareholder, this is basically the holy grail.
It really is.
It means a structurally larger percentage of every single new dollar of management fee bypasses the employee bonus bill entirely and drops straight to your bottom line. It's like operating leverage layered on top of operating leverage.
It is a beautifully engineered financial model. I mean, truly.
Yeah.
But, as you always say on Talk Tickers, we can't just drive looking in the rearview mirror.
Exactly. We know how Acadian crushed Q2. They proved their alpha, they captured global flows, and they let their operating leverage do the heavy lifting. But the stock market is entirely forward-looking.
Yeah.
You don't buy a stock for what it achieved yesterday. You buy it for what the management team is signaling about tomorrow.
Exactly.
So let's pivot to the guidance, because they spent a significant portion of this call detailing a very aggressive push into new talent, new technology, and entirely new asset classes.
The leadership transition they announced is probably the first major signal here.
Right, Alex Voitenok.
Yeah. In a systematic algorithmic firm, your talent and your data architecture are literally your entire product.
There is no charismatic star portfolio manager relying on gut instinct.
No, there's only the machine.
They announced that Alex Voitenok will be stepping up as co-chief investment officer alongside Brendan Bradley effective January 1st, 2027. But what I found really telling were the specific responsibilities outlined for Voitenok.
Right.
He isn't being tasked with macroeconomic forecasting or reading tea leaves. His mandate is heavily focused on data, infrastructure, and what they called investment engineering.
And that phrase, investment engineering, should be flashing in neon lights for anyone evaluating this company's competitive moat.
Why is that so critical?
It reveals a fundamental belief that the future of quantitative finance will not be won by those with the best financial theories, but by those with the best plumbing.
The plumbing being the ability to just ingest and process data.
Precisely. If we connect this to the bigger picture, the sheer volume of alternative data available today is just staggering. We aren't just talking about reading quarterly balance sheets anymore.
Right.
The data landscape has exploded.
We are talking about natural language processing algorithms that scan millions of social media posts to gauge consumer sentiment, right?
Yes.
Or satellite imagery tracking the number of cars in Walmart parking lots to predict retail sales. Or scraping global shipping logs to predict supply chain bottlenecks before they even hit the official economic reports.
And ingesting all of that unstructured data, cleaning it, which is incredibly difficult, and feeding it into a trading model in milliseconds. That requires elite software engineering, not just financial acumen.
Yeah.
Which leads perfectly into the other major talent announcement they made. The integration of the former TC43 investment team, and specifically calling out Jonathan Briggs.
CEO Kelly Young stated that absorbing this team will accelerate Acadian's research and data engineering capabilities.
Right.
It sounds almost like they are bolting a specialized Silicon Valley tech incubator directly onto the side of their 40-year-old algorithmic core.
And they have to do that. Systematic investing is a relentless arms race. Alpha decays.
Alpha decays. Explain that for the listener.
If an algorithm discovers a unique pricing inefficiency in the market and starts exploiting it for profit, other quantitative firms will eventually discover that exact same inefficiency.
Because they have similar models and similar data.
Exactly. And when everyone tries to exploit it at the same time, the inefficiency disappears. The alpha literally decays to zero.
So you have to constantly be finding the next inefficiency. If you rest on your laurels, your models just stop working.
Yep.
By institutionalizing this investment engineering approach under Voitenok and integrating the TC43 researchers, Acadian is actively trying to future-proof that 96% outperformance rate we talked about earlier.
That's the game plan.
I buy that. It makes total strategic sense. But what gives me a bit of pause is how they're attempting to deploy that technology into new markets.
Okay, let's hear it.
Let's talk about the new product frontiers, starting with the tax-aware funds. They recently launched 2 of these, a global and a U.S. strategy, and noted they already have $100 million in managed assets there.
Right.
They highlighted that 20 to 25% of their total firm assets are now intermediated through the wealth channel. Why is tax-aware investing suddenly the absolute key to unlocking this specific demographic?
To understand that, you really have to look at the difference between an institutional client and a wealth management client. For decades, Acadian's primary clients were likely massive pension funds, sovereign wealth funds, or huge university endowments. And those entities are generally tax exempt.
Right. A state pension fund doesn't pay capital gains taxes when it sells a stock for a profit. They just care about the raw pre-tax alpha.
But the wealth channel is entirely different. This channel represents financial advisors managing money for high net worth individuals.
Families, basically.
Exactly. And for a high net worth individual, taxes are the ultimate enemy of compounding wealth.
Right. If the algorithm generates a brilliant 10% return, but the investor has to pay like 3 or 4% of that in short-term capital gains taxes because the algorithm was constantly trading in and out of positions,
Yeah.
the investor only actually feels a 6% return.
Exactly. And this is where systematic investing has a massive structural advantage over human portfolio managers.
How so?
Well, a human manager cannot efficiently monitor a portfolio of 500 stocks every single day to look for minute opportunities to harvest tax losses. But a computer can do it instantly.
Let's define tax loss harvesting for the listener, just to be totally thorough.
Sure. If the algorithm holds a stock that is temporarily dropped in value, it can automatically sell that stock to lock in the paper loss and then immediately buy a highly correlated similar stock to maintain the portfolio's overall market exposure.
Okay, so they might sell Exxon at a loss and immediately buy Chevron.
Exactly.
They stay invested in the oil sector so they don't miss a rebound, but they generated a capital loss on paper.
And that generated loss can be used to offset the capital gains from their winning trades, which dramatically lowers the client's tax bill at the end of the year.
It's like finding free money in the tax code.
Yes. By launching these specific tax-aware funds, Acadian is taking their core algorithmic engine and optimizing the final output specifically for after-tax returns.
So it is a custom-built solution for a wealth channel that already controls a quarter of their assets.
Right. And it makes their product incredibly sticky. Sticky? Yeah, meaning once a financial advisor integrates a highly efficient tax loss harvesting engine into a client's portfolio, they're very reluctant to remove it. The switching costs are just too high emotionally and financially.
Okay, here is where it gets really interesting, but also where I have to throw up a massive red flag.
No.
I see the logic in optimizing equity algorithms for taxes. That makes sense. But management also highlighted their expansion into systematic credit.
Right.
They specifically mentioned that their U.S. high-yield product will hit a critical 3-year track record late this year, which they say will pave the way for a major asset-raising ramp-up in 2027.
The credit markets, corporate bonds, high-yield debt, they are widely considered the next massive frontier for systematic managers.
But I'm going to push back hard on this. Can a purely equity-focused systematic shop really stretch into high-yield credit without breaking their models?
It's a leap, for sure.
This feels like classic diversification, trying to be everything to everyone just to chase AUM growth. You were talking about moving from trading highly liquid stocks on electronic exchanges to trading junk bonds in the over-the-counter market.
It is a fundamentally different market structure. You are absolutely right to point that out.
The data isn't clean. If I want to know the price of Apple stock, I can look it up to the penny, updated every millisecond.
Yeah.
But a specific tranche of high-yield corporate debt issued by some mid-sized manufacturing company, it might not have traded for 3 weeks.
It's true. It's very illiquid.
The pricing is often based on dealer quotes, not actual trades. So how does an algorithmic model process illiquidity and stale data without making catastrophic errors? We have seen prominent equity quants blow up spectacularly when they tried to pivot to fixed income.
Your skepticism is entirely warranted. And honestly, it is the exact reason why that 3-year track record management mentioned is so vital.
Okay, unpack that for me.
You are correct that the fixed income market is messier. It's more fragmented, and it suffers from massive liquidity pockets. But that messiness is precisely where a sophisticated data processor can actually find an edge.
Assuming they have the right data, though.
Yes, the inputs change drastically. You aren't just looking at price momentum like in equities.
Right.
You are scraping credit default swap spreads, analyzing textual sentiment in complex bond covenants, and modeling default probabilities based on massive macroeconomic indicators.
It's a totally different beast.
It is. But the core competency, the ability to rigorously test hypotheses against vast data sets without human emotional bias, that remains exactly the same.
So they are basically taking the same engine block, but realizing it can be tuned to run on diesel fuel instead of unleaded.
That is a very fair comparison. But let's go back to the 3-year track record, because this is the actionable catalyst for the listener.
Right.
In the institutional world, consultants and pension boards operate under incredibly strict governance rules. In many cases, it is literally written into their bylaws that they cannot allocate capital to a new investment strategy that does not have at least 36 months of live, verifiable performance data.
Okay, so they don't care if your back test shows you would have made 50% a year for the last decade.
Exactly. A back test is just a simulation. It's easy to make a back test look perfect. They need to see how the algorithm handled live money during real market panic.
So Acadian has been quietly incubating this U.S. high-yield strategy for almost 3 years.
Yep.
They have absorbed the development costs, they have refined the execution algorithms to handle the illiquidity you mentioned, and they have built the real-world data set.
And when that 36-month clock hits zero late this year, a massive door unlocks.
They suddenly become eligible to bid on billions of dollars in new requests for proposal RFPs from institutional fixed income allocators.
Management is explicitly telling the market, we are planting the seeds right now, so watch 2027 for a major structural revenue catalyst in a completely new asset class.
Wow, okay. Which brings us to the final piece of our analysis, the bottom line. We have mapped out the blowout Q2 numbers, we have identified the operating leverage driven by enhanced product demand, and we have dissected their aggressive roadmap for tech and credit expansion.
We've covered a lot of ground.
Now we bring it all together to answer the most important question for you, the retail investor. Do you buy, hold, or sell? And to finalize this, we really need to look at how management treats its own capital.
The capital return metrics are undeniably robust. In the second quarter alone, they used $10.6 million to repurchase 0.2 million shares at an average price of $69.92.
Which, given the $1.33 EPS they just printed, implies they are buying back their own stock at a very, very reasonable multiple.
Very reasonable.
But the longer-term trend is what truly stunned me. Over the last several years, they have decreased their outstanding diluted share count by a massive 58%.
It's incredible.
They went from roughly 86 million shares in 2019 down to just 35.7 million shares today.
That is aggressive financial engineering in the best possible sense. By shrinking the float, the number of shares available to trade on the open market, they are mechanically inflating the earnings per share for every single remaining investor.
They are essentially buying out their partners. If a pizza is cut into 8 slices and the company buys back 4 of those slices and destroys them,
Right.
your single slice suddenly represents a much larger percentage of the total pie. And on top of those repurchases, they declared a 10-cent interim dividend to be paid in September. They are just showering shareholders with cash.
And crucially, they are doing this without compromising the structural integrity of the firm. Their balance sheet remains absolutely bulletproof.
Let's hear the numbers.
They are holding $65 million in pure cash, alongside $110 million in seed investments.
We touched on this briefly earlier, but let's clarify those seed investments. That $110 million isn't just money sitting in a vault gathering dust.
No, not at all.
Yeah.
It is highly strategic capital. When Acadian wants to launch a new fund, like the tax-aware strategies or that U.S. high-yield credit fund we just analyzed, they can't just open an empty fund and ask clients to be the first ones in.
Right. Nobody wants to be the guinea pig.
Exactly. So they use their own corporate cash to seed the fund, providing the initial scale necessary to trade efficiently and build that critical 3-year track record.
So that $110 million represents their proprietary capital actively deployed in their newest, most innovative models.
Yep.
It is the ultimate proof of alignment with their clients. They are literally eating their own cooking. And regarding their debt profile,
incredibly conservative. Their gross debt to adjusted EBITDA ratio is sitting at just 0.8 times.
Okay, that's low.
Very low. This is well below management's stated through the cycle target of 1.5 times. Furthermore, because their free cash flow was so overwhelmingly strong this quarter, they actually paid off their seasonal revolver borrowings ahead of schedule.
So they have maximum financial flexibility.
Mm-hmm.
When we weigh the totality of this evidence, the 47% revenue growth, the 10-point margin expansion, the global demand for enhanced strategies, the declining variable comp ratio, and a balance sheet that allows for aggressive share buybacks, we have to take a definitive stance. And frankly, it is incredibly difficult to be anything but deeply bullish on AUM stock.
I agree entirely. The combination of sustained organic growth in an industry that is otherwise plagued by outflows paired with textbook operating leverage creates a compounding machine.
So here is the actionable advice for you based on our analysis. If you currently hold AMI in your portfolio, this is a classic hold and compound scenario.
Right.
Ensure your dividends are set to reinvest. Let the management team continue their aggressive share repurchase program to shrink the float. And just enjoy owning a pure play, highly efficient, systematic manager that is executing its strategic roadmap flawlessly.
And if you do not own the stock, but are evaluating an entry point, you really need to factor in the 2027 systematic credit catalyst.
Right, that 3-year track record unlocking.
Exactly. The broader market typically struggles to price in events that are further than 2 quarters out. The unlocking of that high-yield track record could trigger the next massive wave of AUM growth,
which drives a whole new cycle of operating leverage that is simply not currently reflected in the share price.
It is a phenomenal case study of a 40-year-old firm continuing to find entirely new gears.
But as always, before we let you go, we want to leave you with one final provocative thought, a puzzle piece for you to mull over as you stress test your own portfolio assumptions.
We have spent this entire deep dive praising Acadian's systematic, data-driven methodology.
We have.
Their entire competitive moat, their incredible operating leverage, and their massive AUM growth are fundamentally predicated on one core assumption: that historical data contains repeatable patterns that can successfully predict future market behavior.
But as they scale past $232 billion, and as they push their algorithms into increasingly complex territories like long-short extension strategies and illiquid high-yield credit,
right,
a critical vulnerability emerges.
What happens when the historical data ceases to be relevant? What happens if the global financial system experiences a truly unprecedented black swan paradigm shift?
We are talking about events with literally zero historical precedent in the data sets, a sudden cascading geopolitical collapse, or an overnight artificial intelligence disruption that fundamentally alters the nature of corporate labor, or a sovereign debt crisis in a developed nation that just breaks the foundational math of bond yields.
If a quantitative model is trained on 40 years of historical market behavior, but the reality of tomorrow looks fundamentally alien to anything in that data set, the machine is flying blind.
Exactly.
The question is, can a purely algorithmic system adapt to a new paradigm in real time, or will it confidently, unemotionally execute billions of dollars in trades based on the ghosts of a market that no longer exists?
It is the ultimate paradox of the systematic model. The more flawlessly you optimize the engine to run on a specific track, the more catastrophic the failure if you suddenly find yourself driving on a completely different surface.
The data is perfect right up until the moment it isn't.
Something for you to consider as you decide how much faith you want to place in the machine. That wraps up this earnings breakdown. We've disassembled the numbers, we've analyzed the mechanics, and we've outlined the catalysts.
Keep challenging the narratives and keep hunting for that operating leverage.
And we will catch you on the next deep dive.